Welcome to the Explainer. Today, we're putting Masterbrand, ticker symbol MBC, through an absolute gauntlet of evaluation. We're going to use the exact analytical frameworks of legendary investors. We're talking Warren Buffett, Peter Lynch, and Benjamin Graham, and we'll be placing those alongside some strict quantitative models like discounted cash flow. Our objective here is simple. Slice right through the market noise, dig into the raw data, and figure out the true intrinsic value of this stock.
Here's our roadmap for the analysis. We've got Section 1, Company Snapshot, Section 2, the Warren Buffett lens, Section 3, the Peter Lynch lens, Section 4, the Benjamin Graham lens, Section 5, DCF and alternative models, and finally, Section 6, Final Investment Synthesis.
All right, let's dive into Section 1, Company Snapshot.
So what exactly are we dealing with here? Well, Masterbrand is the #1 North American residential cabinet manufacturer. We're talking a massive operation with a network of over 7,900 dealers and more than 20 manufacturing facilities. Looking ahead to 2025, they're projected to hit $2.7 billion in net sales, with an adjusted EBITDA, which is basically their core operational cash profit, of $298 million. This is an absolute giant in the building products industry. But keep in mind, they are heavily exposed to renovation and remodeling, which makes up about 60% of their net sales. Now, despite being this massive industry leader, the stock is currently sitting at just $8.90, giving it a market cap of $1.82 billion. They are pulling in a positive free cash flow of $12.5 million, which is definitely a good sign. But you have to look at that bottom line. Their earnings per share over the last 12 months is -2 cents. They actually posted a net loss of $2 million. And let me tell you, that negative EPS is going to throw a massive wrench into our classic valuation models in just a minute. You might be wondering, why is the market punishing the #1 player in this space so heavily? Well, Pzena Investment Management actually hit the nail on the head. They pointed out that the stock is trading at this depressed valuation because of some pretty heavy macroeconomic headwinds. We're looking at a prolonged slump in housing turnover, combined with some really intense tariff-related cost pressures on their imported components. But, and this is the kicker, Pzena notes that these are temporary headwinds masking Masterbrand's true normalized earnings power, especially when you factor in their pending acquisition of American Woodmark, which is the 3rd largest player in the industry. Honestly, this sets up like a classic turnaround play.
Moving right along to Section 2, the Warren Buffett lens.
Before we actually grade the stock, we need to quickly define a core Buffett concept, and that is owner earnings. Buffett loves this metric way more than standard accounting profit. Why? Because it represents the true cash a business generates after paying for all the capital expenditures they need just to maintain their long-term competitive position. For our purposes today, we'll use Masterbrand's free cash flow as a proxy for these owner earnings. So, how do they stack up on the Buffett scorecard? First up, economic moat. That's a pass. Being the #1 player with a giant dealer network definitely gives them scale and pricing power. Manageable debt? That's also a pass. Their debt-to-equity ratio has actually been dropping year over year and sits at a very healthy 0.72. But here's where we hit a bit of a wall. High return on equity, which tells us how efficiently they use shareholder money, is a definitive fail. Their current ROE is -0.15%. And when it comes to owner earnings, well, they do have that $12.5 million in positive free cash flow, sure, but Buffett would look at that trailing net loss of $2 million with extreme caution. He demands consistent, predictable earnings, and right now, Masterbrand just doesn't have them.
Okay, Section 3, the Peter Lynch lens.
Now, Peter Lynch famously categorized companies into 6 buckets. You've got your slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Take a second and think about this. Based on what we've unpacked so far, what category do you think Masterbrand falls into right now? If you guessed a mix of a cyclical and a turnaround, you are absolutely right. It's cyclical because it's tied so heavily to the housing market, and it's a turnaround pending that American Woodmark acquisition. Now, Lynch's absolute favorite metric is the PEG ratio, which compares the PE ratio directly against growth. But remember that negative EPS we talked about? Because of that, we literally can't calculate a PEG ratio here. That's a big warning sign. Next, institutional ownership sits at over 66%. Lynch hates this. He wants hidden gems that Wall Street is ignoring. But with 2/3 of the shares held by institutions, the smart money is already super crowded in this trade. The one bright spot for Lynch, that 0.72 debt-to-equity ratio, means the balance sheet is solid. Let's shift gears to Section 4, the Benjamin Graham lens.
We are going to run MasterBrand through Graham's famously strict defensive investor checklist. Adequate size? Yes, with nearly $2.7 billion in revenue, they easily clear his $1 billion hurdle. Strong financial condition? Yes again. The debt to equity is comfortably below 1. But remember, Graham is the father of value investing. He demands absolute safety. Earnings stability? Fail. They're currently posting a net loss. A strong dividend record? Fail again. MasterBrand doesn't pay a dividend. For a strict Graham defensive investor, failing these safety checks means you walk away immediately, no questions asked.
And look what happens if we actually try to force his famous intrinsic value formula. It's mathematically impossible. The formula asks us to take the square root of earnings per share multiplied by book value. But since MasterBrand's current EPS is -2 cents, taking the square root of a negative number just gives you an imaginary number. Benjamin Graham's calculator literally explodes right here. This is exactly why purely backward-looking historical models can completely break down when evaluating a company that's going through a temporary cyclical downturn.
That brings us to Section 5, DCF and Alternative Models.
Let's get a little more quantitative and build out a base case discounted cash flow model. We've got 4 steps here. First, we anchor the model with our current free cash flow baseline of $12.5 million. Second, we have to discount those future cash flows back to today using MasterBrand's weighted average cost of capital. Think of this as the specific risk rate of their money, which sits at 8.80%. Third, we're going to project out some moderate future growth, basically assuming the housing market eventually normalizes and the American Woodmark acquisition brings in some operational efficiencies. Finally, we calculate the terminal value to capture what the company is worth forever into the future.
Now, a DCF model is incredibly sensitive to the assumptions you feed it. If we stick to our 8.80% base WACC and just assume a conservative 1% terminal growth rate, we establish our base valuation. But look at how tweaking these inputs changes the whole game. If that cost of capital drops just a bit to 7.80% and long-term growth inches up to 2%, the fair value absolutely skyrockets. On the flip side, higher capital costs and lower growth totally destroy the value. Seeing this wide dispersion proves exactly why building in a margin of safety is absolutely crucial.
Taking an alternative route, remember PZina Investment Management? Instead of getting bogged down in trailing metrics, they look at normalized earnings. And by their calculations, MasterBrand is currently trading at an incredibly cheap multiple of just 5.5 times their estimate of normalized earnings. Think about that for a second. If you believe the housing slump is temporary and they can navigate the tariffs, getting a 5.5x multiple on a market-leading company implies some massive asymmetrical upside potential, something that the strict Graham and Lynch models simply can't see. All right, Section 6, Final Investment Synthesis.
Putting all these frameworks side by side reveals a pretty massive divergence. Warren Buffett would rate this a hold. He loves the moat and the low debt for sure, but he's going to demand a return to positive ROE before he even thinks about buying. Peter Lynch is also a hold. It's a perfectly valid turnaround play, but with 66% institutional ownership, it's just too crowded for his taste. Benjamin Graham is a definitive sell or avoid. The negative EPS and no dividend mean it completely fails his safety tests outright. But then you look at the forward-looking quantitative models like PZina's, and they rate this a strong buy based entirely on that deep discount to normalized earnings power.
Ultimately, what we're looking at with MasterBrand right now is a fundamental tug-of-war between market dominance and macroeconomic headwinds. The key strengths are totally undeniable. They are the number one player, the American Woodmark acquisition is a massive catalyst for scale, and their debt is super manageable at 0.72. But the risks are immediate and they are very real. The housing slump is dragging on, tariffs are compressing their margins, and of course their bottom line is currently negative. So when we blend all of these frameworks together, our final verdict for MasterBrand at its current price of $8.90 is a hold. The underlying business is solid, and that normalized upside is incredibly compelling. But for a prudent value investor, you really need some patience here. We recommend holding and waiting for 2 specific triggers: the successful closing of that American Woodmark acquisition and hard mathematical confirmation that trailing earnings per share have flipped back into positive territory.
As we wrap this up, I want to leave you with something to really think about. If a transformative acquisition and some temporary macroeconomic headwinds are masking MasterBrand's true long-term value, are incredibly strict, backward-looking models like Benjamin Graham's actually blinding us to the most lucrative turnaround opportunities out there? It is a fascinating tension between demanding current safety and projecting future growth. Thank you so much for joining me on this deep dive. Keep analyzing, keep questioning the numbers, and I will see you on the next explainer.